Good evening. So this is a commentary for the Asian session for yesterday's trading. Okay, so we've indicated our sales and liquidity, which is the session due on liquidity, because from the morning session, from the morning New York session, we were expecting lower prices. Our due on liquidity is the 5,600 level. So this is also indicating the new week opening gaps and also the new day opening gap using the new week opening gap slash new day opening gap indicator. All right. So when this is seen in price, because we're expecting lower prices, this new week and new day opening gap, we're expecting it to act as a support broken turn resistance, so thereby expecting lower prices. And as you can see, the first stage distribution was the breakaway gap. So we do not want this price action, this body of price action, to trade above that breakaway gap. So thereby that is our invalidation point. Price action is allowed to have a little trade up inside of the fair value gap, but should not elapse, and we should not see a body close inside of that gap. So the midpoint of the discount week, as you can see, is the target one. So that is it. And our entry point is the midpoint of the consequent encroachment of the week, of the order block week. So as you can see, there's an order block after the breakaway gap was created. So we note the midpoint of that week, because when you have a long week in price action, you're interested in the midpoint. So here we have the volume imbalance, and here we have a fair value gap on the premium. So we cut through candles. So for PDRs, whenever two PDRs are closely by one another, you can look for the equilibrium of those equilibriums of the PDRs, and the midpoint of it is the gray pool, right? So we continue tape reading. So we've indicated the invalidation point, which is the red horizontal trend line there. So we already traded above the midnight opening price. So we are always interested in opening prices, because price goes above true opening for smart money sell orders and below true openings for smart money buy orders. So thereby we've indicated our true opening prices. So we'd want to take something off at the new week opening gap high. So when we have a trade inside of the midpoint of the midpoint of the order block, we are expecting to take something off at the new week opening gap high. So now, while Asia doing New York, we observed a market maker sell model on the 4-hour time frame. So when you have a market maker sell model or a market maker model on a higher time frame, you're going to a lower time frame to look for a fractal nature of that market maker model. So because price is fractal in nature, so what is going on the higher time frame is also going on in the lower time frame. It might not look exactly identical to each other, but you get the gist. So here we have buy side liquidity here on the 1 minute time frame. So here is the short-term buy side liquidity. So price will likely go up here to take out sell buy side liquidity to pair up smart money buy entries, because smart money buys above old highs, because old highs you already have resting orders above those highs, which are buy side liquidity, and below old lows we have sell side liquidity, which is where we would want to take partials off. All right. So we wait. We do not do anything unless we have a pairing of liquidity on the opposite side of our intended move. So the opposite side of our current intended move is the buy side. So we go into the Nasdaq, which is the US 100, to look for a to see the correlation of likely correlated assets. So because there's a market maker sell model also on the Nasdaq, means we are on the right side of the market, because closely correlated assets gives clearer vision on where the market is likely to go to next. So you can use inversely correlated asset classes like the USD card or the US dollar to confirm the direction of price. So here we have the consequent encroachment of the order block week we spoke about, and the order block week is at a premium level because it is above current market price and it is currently above the midpoint of the range we are currently working inside of. So the order block of for 8:05 p.m. So we are expecting price to trade to the lower portion of this order block and then immediately drop lower. But before we get this trade higher, we want price to quickly draw higher, quickly rally higher. That rally higher, it is speed, it is of importance because it will make the resting orders there, the traders that place their stop losses or their stop loss order, even though they are correct in their directional bias where they want price to go, but because they are wrong in their stop placement and their logic, the that when price rallies higher to take out buy side liquidity, it will neutralize them and neutralize their stop, and it will keep them paralyzed from taking any further move. This is what you want to see in the body of price action. When you have something like this is of a high probability setup because you have narrative in play. Narrative being who is currently making money in the marketplace and how are you going to use the resting liquidity? How are you going to use their resting liquidity to facilitate your own personal orders? So this video is sped up for your convenience. So as you can see from the brokerage gap, we noted the midpoint of the brokerage gap and indicated it has done fill, and our stop loss is being placed at the eye of the main point, which is the invalidation point, which is the consequent encroachment. So the eye of the consequent encroachment is our invalidation point. Price is allowed to wick to the lower half of the breakaway gap. So because it's a breakaway gap, we do not even expect it to be filled in any way. But this is live price action. So let's continue. So we've placed a limit order to avoid any ambiguity when expecting price to play out as it should. So as you can see, the Asia session, all session have the accumulation, the manipulation, and the distribution phase. So when you're getting your model, you should pick a model around these phases. So the phases includes time. So during the 8 p.m. to the 9 p.m. time window, this is when the distribution phase takes place. So because you're expecting a distribution to the downside, you are any rally up higher, it is seen as a manipulation leg. So anytime price rallies higher, you see that as price making a false move to trick in buyers at the higher price. So now we've been tagged in, and at this moment, buyers will flood into the market at the higher price because they do not want to miss out. So they are paralyzed with the fear of missing out. So this is what we want. Narrative is in play because we already have a trade idea that is opposed to the retail logic. So now these buyers that comes into the market at a higher price, we use their higher price buy orders, their liquidity, and we use it to facilitate our own sell orders. So sell positions have been placed here by smart money entity. So here is the minor buy side liquidity because price goes above old highs to pair buy side liquidity. At this point in time, I would like to take partials off above at the new day opening gaps high. So we place 5 positions to be taken off. This should have been a buy stop order, not a sell stop order. That was a mistake because I barely use this trading view platform for live trading. I mostly use the MetaTrader for live trading. So our take profit has been tagged. We took partials off and remaining 15 contracts. So now we wait because price is respecting our idea of order flow. So when order flow is being respected by the algorithm, you pay more attention on price and not on the candlesticks, because the candlesticks can start acting like a distraction at this point in time, especially when your first target has been hit. This is not the time for you to adjust your stop loss. Do not be fearful to adjust your stop loss. You leave your stop loss where it should be. You should likely adjust your stop loss when you have gotten at least to your target number 2. That is when you are allowed to move your stop loss. So now we currently have an imbalance now, and this imbalance now we are waiting any rally higher. That rally should be seen as a rally trying to rebalance this imbalance. And as we noted from the teachings of market structure, when an intermediate term high is created that has balanced an imbalance, price will leave an order block or a fair value gap. This order block or fair value gap, it is seen as the final boarding call by the algorithm for a market maker model. So when the algorithm has already completed its first stage distribution and and splitting its second stage distribution, during the second stage distribution, this is the algorithm indicating to the smart money traders that are in the know that price is calling for its final boarding. So we had this bearish order block which was created inside of this imbalance, which is the intermediate term high. So now we can move our stop loss, we can adjust our stop loss because we do not want this intermediate term high to be violated. Because of a bearish narrative, the intermediate term high should be kept intact. So we had one more trade inside of the fair order block. This should have been a pyramid entry if we were to pyramid, but this is not the idea for this video. So we traded up into the fair value gap, which is also a balance price range because we have buy side delivery and sell side delivery, which is a BC and a CB, which jogged down lower and price chase to a bearish order block, which is accompanied with a fair value gap. So currently now, this is us trading to the mean threshold of that set of up close candles, which is the other blocks. So we do not want to see body closes, consecutive body closes above the midpoint of this mean threshold, because this is problematic. Because when order flow is bearish, we do not want the best fills will be formed below the equilibrium of a PDRA. So when you're expecting order flow, when you're expecting a bearish order flow, you do not want to see body closes above the midpoint, and inversely, when you're expecting higher prices, you do not want to see body closes below the midpoint of a PDRA. So when you are trading and you have your chart all marked up like this, you can make use of Control Alternate H to hide all the writings. So like we said earlier, I would want this new day opening gap, consequent encroachment, the midpoint of the high of the new day opening gap and the low of that opening gap. I would want it to act as a support, broken, turn, resistance. You get the logic. So when it is broken to the downside, when price trades above higher, I would want it to act as a resistance, resisting price from going higher. So now I would want to see speed. I would want to see speed to neutralize the traders that have placed their stop loss below this recently created low, because they'll see that as a fake out. So now they'll be panicking. because price is coming to their stop loss. So now we have them being neutralized and we take partials off at these lows because we already have sell side liquidity by those traders that just place their stop loss. So because we're still expecting far lower prices, would leave a couple of contracts to go lower, and whether or not it gets to our final terminus, it doesn't matter because we have managed trade properly and we've taken partials at logical points. All right, I hope you got something from this video, and I'll talk to you tomorrow, and goodbye.